meant to kind of pull back the veil of what's called a venture capital firm. Has anyone here heard of a venture capital firm before? Okay, there's a few people who have, which is great to see. But I find that a lot of entrepreneurs are familiar with this concept of venture capital, and they put a lot of focus and attention on seeking venture capital financing for their companies. And from what I see is the reason for that is because, of course, they need capital, but they also believe that as long as they get financed by a venture capitalist, their chances of success will be a lot higher. And so many entrepreneurs that I see are seeking VC financing as one of the most important focal points of their entire business and their entire business model. I've seen incubators and accelerators who bring in a lot of companies and basically have a whole program structured around creating a pitch deck or an investor presentation or an event to pitch investors. But when I peel back the layers of understanding among these entrepreneurs, I find that there is a massive disconnect between what entrepreneurs think and expect a venture capital firm is and how we invest into early stage companies. And unfortunately, that misunderstanding very often leads to a massive amount of time wasted on behalf of the entrepreneur, because they're, again, putting so much focus not on establishing their business model, bringing it to market, receiving validation from the customer segment, but instead trying to structure a business that they hope a VC will invest in. And then also not fully understanding why a VC will make a decision to invest in a particular company creates a huge amount of wasted time and an outcome that is not generally successful. And that's why accessing VC financing seems so challenging to most entrepreneurs. And I think it really is as simple as they just really don't understand what they need to in regards to a venture capital firm. And that's what I hope to address today. What the heck is this thing called a VC firm or a VC fund? How do we make investments? And then you can look internally at your own company and decide, is my company the type of company that is good for a VC? How can I use insights from how venture capitalists select investment opportunities and then grow companies in our portfolio to use that for my own establishment of my own business model? All right, so let's get into it. As you heard, I'm not just the CEO of Pycap, but I'm also a former instructor at the Schulich School of Business as well as the University of Toronto. I've taught BBA programs, MBA programs, and Master of Finance programs, all related to venture capital, private equity, corporate finance, and entrepreneurship. And in addition to that, I'm the co-founder and former chief financial officer of an electric vehicle infrastructure company called ChargerQuest. And while I was with that company, we raised over $4 million, and we had, I believe it was about 200 publicly available electric vehicle charging stations, all interconnected throughout 7 provinces in Canada. And on top of all of that, I'm on the investment committee and have been on this committee for about 10 years at OCI, which is an Ontario government-backed venture firm. And every year they deploy over $100 million into early stage companies. And so on this investment committee, I'm sitting there among other venture capitalists. There's 5 of us in total, and they bring a company to us to evaluate. And we essentially help OCI decide, should they actually make this investment? Should Ontario taxpaying dollars go into these companies? Do they have the right attributes, features to execute on their vision? Or should we redirect the funds elsewhere? Okay, so let's take it from the top. What is a venture capital fund? So what is a fund? A fund, just like a mutual fund or an exchange traded fund or a hedge fund, is essentially a pool of capital that is used by a manager to invest on behalf of investors who put money into the fund. So it's like imagine like a bucket of cash that the manager distributes into different assets. And for VCs, it's a little bit different than other types of fund managers. So a venture capitalist is a fund manager, and what they invest in is early stage tech companies, predominantly. Another thing that makes VCs fundamentally different than other fund managers is the fact that venture capitalists get actively involved in the companies within their portfolio. So unlike a mutual fund manager who might invest in Tesla or Apple or Rogers, the VC doesn't just try to pick undervalued companies and hope that the share price increases. The VC is more of a growth investor that sits along with the entrepreneur and acts like the entrepreneur's partner in terms of identifying opportunities to grow the company with you. So it's very much kind of a partnership. It's not just a passive investment. And that's an important thing to realize, again, when you're pitching a venture capitalist, because they are going to be working with you. They need to see that they can add value in your business. And when any investment is made within the world of finance, there's always a trade-off between what we call the two pillars of the investing world. Does anyone know what those two pillars are? They each start with the letter R.
Risk and reward.
That's right, risk and reward, or risk and return. That's exactly right. And then when an investor is selecting an asset to deploy capital into, they're always balancing those two things. They're looking at an investment opportunity and they're saying, okay, this investment opportunity has a certain level of risk. And in order for me to take on that level of risk, I need to be compensated with a sizable amount of return. So for example, if you're pitching an early stage tech company, and that early stage tech company, because it doesn't have a long track record and you're a first time entrepreneur and you're inventing a product that maybe you haven't developed yet, that inherently has a high level of risk. Like imagine a recent graduate from Waterloo University who's maybe in their early 20s, literally pitching you and saying, can you please invest $20,000 into my company? Your first question might be, well, what is the company? What are you producing? What have you done before? And the less they have done, the less they have validated, of course, the more risk goes up. So then you have to ask yourself, okay, well, there's a high level of risk here. Well, how am I being rewarded for that high level of risk? I need to have a high level of return. And that's exactly why venture capitalists look to invest in tech companies, because tech companies, predominantly software, have the highest return potential out of any other asset class for a number of different reasons, mainly related to scalability.
So I'm just going to interrupt.
Sure.
They want this a little bit.
Risk and return trade-off. Can everyone hear me okay right now?
Yes.
Yes. 10 minutes left. Okay, all right, I'll speed things up. All right, so let's look at the risk and return trade-off a little bit further. We talked about how an early stage tech company is risky. Remember, it's early stage. When you have an early stage of anything, that means it's just starting out and there's not much of a track record. So when a venture capitalist is looking at your company, they're looking at it not just, is this company risky, what's the return potential, but they're also kind of evaluating you and the opportunity and your ability to add value to your organization. Okay, sure. Okay, so they're looking at you and they're saying, okay, well, how can I de-risk this? Like the return potential is great, but what can we do to take the risk out of the company? So when a VC is going to invest in your business, they essentially are going to have the same goal that you are going to have, or you should have. That's why when
I'm doing a good job of de-risking this.
Yeah, that's right. So, from the risk standpoint, a VC, you should look at your company not as synonymous with yourself.
You should not look at your business like, okay, this is an amazing piece of technology that this world simply must have, or this company is me and I have to make it successful. You should look at it like, this is an entity and an asset that is detached from myself, and I am going to invest my time, energy, and focus into it, and I'm going to position it in such a way where I have the highest potential for return, and I'm doing that by also trying to de-risk it as much as I can. So what type of return potential do venture capitalists look for? We look for a 10x return. So what that essentially means is, when we put our money into something, let's say I'm going to invest $1 million into your company. Within 3 to 5 years, I want 10 times the money I put in out of the business. So I'm going to want $10 million out of your company within 3 to 5 years. So that also speaks to the valuation that you put on your company. If you're pitching a VC and you say to the venture capitalist, my company is so great, I'm going to be revolutioning the world and everybody's going to want it, and my total addressable market is the entire planet, I'm going to make billions and billions of dollars, but I haven't started the product yet. The value of my company is $100 million. They're going to look at you and think, okay, is it likely that this person's company, given the stage that it's at, is going to be worth $1 billion in 3 to 5 years? So that's another thing that you have to kind of keep in mind. Okay, so there's 3 things that a venture capitalist looks at when they evaluate you and your business at the onset. Number 1 is, can the company survive in the short term? So we want to look at your cash flow, your ability to bring in money into your business as soon as possible. Less and less are VCs looking for moonshoot investments, whether we're willing to dump millions and millions of dollars in the hope that one day somebody buys it or you go public without any ability to generate cash flow in the interim. I mean, yes, someone might put up their hand and say, well, what about all of these AI conglomerates like ChatGPT or OpenAI and Claude, etc. Those are exceptions to the rule, essentially. The other thing is can the company grow in the medium term? So we look at it, can the company survive? We don't want the company to go bankrupt early on, obviously. But then it's not just good enough for the company to not die. The company has to grow, because that's where we get the higher return to compensate for the high level of risk. Otherwise, we should just invest in a mutual fund that tracks the TSX index and hope to get 8% return, as opposed to 10 times our money out or 35% return. Yes? Oh, 5 minutes, okay. That's not a question, it's indication. Okay, the other thing is the exit. So we have to do all of these 3 things. So can your company survive in the short term? Can it grow exponentially? Can it scale in the medium term? Can it grow 10 times its original value right now within 3 to 5 years? And within 3 to 5 years, is it likely that we're going to get our money out of our investment in your company? And there's 3 different ways generally that can happen for a venture capitalist. So when we're analyzing companies and we're looking at the risk and return potential, again, don't just use this as an opportunity to say, okay, well, how do I pitch to a VC? Look at this as an opportunity on how do I evaluate my own business. So the first thing is the innovative idea. This speaks to the scalability of it. Does it have the potential to reach a sizable enough customer segment where we can grow? I was in Rio de Janeiro a few weeks ago, and there were Brazilian companies pitching myself and other venture capitalists from different countries, Israel, Germany, the US, Spain, and we were sitting there, they're pitching us, and they had traction, which is great. They had money, they had massive clients on their Rolodex. We were very, very impressed with that. But what they did not have was scalability, or at least the ones that were pitching me. And so I advised them, like when you have humans doing labor in your business, there's only so many hours in a day. If they have to come in and tweak things and service the client, then that's an opportunity for you to make the company more efficient. The more automated you can have a business, the more scalable it is, because it doesn't matter if you have three customers or 100,000 customers, because it's this machine that just kind of doesn't incur that much more expenses vis-a-vis the number of customers and the growth in customers that you onboard. And is it disruptive as well? Is it just another AI chatbot, or can it actually address a fundamental inefficiency in a market that's being neglected? The prototype. So when a venture capitalist looks at your company, they're going to say, okay, is this an idea stage technology, or is this something that I could actually demo and work on? The earlier stage your product is on the scale of bringing it to commercial viability or bringing it to the market, the higher risk it's going to be. Because we as investors don't know if you can actually execute on this idea of a product that you're trying to create. And also, even if you are able to execute on this idea, we don't know if the market wants it, because we need you to validate the demand for your product. Is it proprietary? This speaks to the exit strategy. If somebody's going to come in and buy it, it's good to have a technology that you have invented yourself, that you have patents on, or some other type of protection on the intellectual property, because that's essentially what the acquiring company is going to be looking for. Management team, again, can you execute? If you're a first-time founder, how can you might say to yourself, well, this is a chicken and egg problem. I can't make my company successful with being a first-time founder. I can't get a VC to invest in my business. Well, there are other things you can do to de-risk the lack of experience with your management team. You can get advisors who are serial entrepreneurs. You can get advisors who are lawyers, who are tech experts. For example, at ChargerQuest, they needed someone to fill in the role from a financial perspective to help find investors and pitch investors, and that's why I joined. And then shortly thereafter, we closed on $3.1 million within a few weeks from Bay Street investors. Domain expertise. Do you have experience in the industry that you're selling into? Do you have experience as the type of profile that you're selling to? If you're creating a technology for the construction industry, have you worked in the construction industry? If you haven't, you can de-risk that lack of domain expertise by getting a partner or an advisor on your team or a board member who can fill in that gap, who has the construction background. Strategic relationships, that's another thing we look at. So it is very, very challenging being an entrepreneur. One of the reasons it is so challenging starting a company is because you're creating a product and a brand for the first time. And just like it's challenging for an investor to invest in you because you don't have track record, it's challenging for a customer to buy from you because they've never heard of you before. They've never bought from you before. They're not familiar with you. They don't have that relationship with you. If you go onto Amazon and you are interested in buying a product, what's one of the first things that you do? You check out the reviews. And if you see a product that you're interested in buying, and then you look at the reviews and you see that there's 0 reviews, and you don't know anyone that's ever bought this product before, and you start getting the feeling, am I the first person to ever buy this? What is your likelihood of actually going through with that transaction? Probably quite low. So how does an entrepreneur overcome that challenge? Well, that's where the secret of success called distribution channel partners comes from. That's where an entrepreneur can join forces with somebody who already has an established customer base and partner with you in a mutually beneficial way to connect you with their huge network of customers so you can leapfrog that psychological barrier and then sell to them. ChargerQuest is a great example. We raised $4 million. We didn't raise hundreds of millions of dollars to buy all of this real estate. So how did we access all of the customers that we have? Well, we formed distribution channel partnerships with hotels, shopping malls, parking facilities, basically saying to them, look, let us use a tiny bit of your land for free, and in exchange, we're gonna put a charging station there, and we'll share our revenue with you. So now we have the ability to spread out all over Canada. We're not paying anything for real estate, and we're already getting the traffic flow from customers that would be going to the mall anyways to shop, or a restaurant, or a hotel. These are all the distribution channel partners we were getting, right off the highway. Even still, I can see that money is just coming into these charging stations. And the benefit to our distribution channel partners is essentially that they get to attract EV drivers to their facility who are driving by and they need to charge their vehicle. So when you charge your vehicle, it can take 20 minutes or 30 minutes. You're likely not just gonna sit in your car when there's a restaurant there, or there's a mall there, or there's a hotel there. You're probably gonna go in and use those services. So again, distribution channel partnerships. Market validation, I mentioned that's a critical element for venture capitalists to evaluate your business and prove to themselves, and you should be doing this to yourself as well, that it's worth an investment of your time, energy, reputation, money, etc., etc. So how do you validate that? Well, the number one best way to validate if someone will buy your product is obviously to sell your product. But maybe your product isn't finished yet. Maybe you don't have your distribution channel partners yet, or you can't establish the trust yet with your customer segment to actually sell. So what's next down on the pecking order? Purchase order agreement. So a legally binding document where somebody, you can get to sign the document and say, okay, well, maybe this product isn't finished yet, maybe I don't know you well enough yet to actually buy it, but this is what we're gonna do. If you finish the product by this date and it meets our due diligence requirements, we are guaranteeing legally that we're gonna buy this from you. So you can take that purchase order and show it to a venture capitalist and say, I've just validated my market. I have a legally binding agreement from a customer saying they're gonna buy from us. What if you don't have a purchase order agreement? What's the next level down on the pecking order? We would call that an LOI, or a letter of intent. So now I'm talking about a document that is non-legally binding. So that's going to a potential customer and saying, okay, well, I'm not holding you to this, but I would at least like to be able to get something in writing that shows that you're possibly at least interested in the idea of buying from us. If we meet these specs, this due diligence requirement, this time frame, etc., etc. So then you have something else that you can validate for yourself, that there is a market for your product before you spend too much time, energy, and focus in creating it. But you can also take that to a potential investor and say, I've done what I could to validate the customer segment and to prove that they actually want to buy this product. And then if, of course, you don't have LOIs, maybe you can consider getting surveys done, go online, get communication of any way, shape, or form with your customer segment to show that they're following you, they're interested, and they might be there for you when you eventually commercialize your product. Okay, so now we're going to talk about the third element, the exit opportunity. So if a venture capitalist is evaluating your business, as I mentioned, just a little recap from the beginning, they're going to look at those three things. Can they survive in the short term? Can they scale and grow exponentially in the medium term? And can they exit in the long term? Someone just got a call for an exit right now. They want to buy the product for $100 million. Hopefully soon, someone in this room will have that. Okay, so the exit. This is something that's unique to venture capitalists. So remember, this isn't a presentation about how to make your company successful. This is a presentation about what VCs invest in. So we have a small window of what we can invest in. And I don't want entrepreneurs to think, okay, my company doesn't fit into those requirements. Because it doesn't mean a company won't be successful. There's a lot of successful restaurants out there, hotels, you name it. but they're not necessarily a good VC investment because they don't necessarily hit all of those three things. So if your company doesn't necessarily fit into the VC mold, don't be discouraged. Use what you can from this presentation in terms of what might work for you. So the third thing that a VC must have, and we must have all of these three things in order to have a successful investment, is the exit. If we do not have an exit, then we're in a paper-rich, cash-poor situation where we invest in something, and even if it grows to billions of dollars, if we can't pull our money out, then it means nothing to us or the investors who put money into our fund. It's on a piece of paper, it looks great, but in your bank account, it doesn't. So we need a cash-rich situation, not just a paper-rich situation. So what is an exit and how do we get an exit? So an exit, all it is a venture capitalist or an investor or even yourself, any shareholder in your business where they exit the position they are in while holding your equity. So if the business gets acquired or bought by a strategic organization, corporation, that's an exit. In fact, that's the most highly lucrative sought after exit, usually because it instills within it something called a strategic acquisition premium. But how does that happen? Why would a company buy your company? Well, this usually happens in a vertical way or a horizontal way. So when I'm talking about vertical, I'm talking about either your supplier buying you, or I'm talking about your customer buying you. When I'm talking about horizontal, that's what I'm talking about your competitors buying you. So let me give you an example of a horizontal acquisition. Has anyone heard of an accounting firm called H&R Block? So they do taxes for individuals and small businesses. They've been around for Lord knows how long, 50 years, 100 years, I'm not sure. They're a massive conglomerate in Canada, and they feel like they've been around forever. They're a legacy player. Now, in come a company called Wave Accounting. Has anyone heard of Wave Accounting? So Wave Accounting is a software platform that automates your accounting for you, for individuals, and particularly for small businesses. When I was starting Pycap, we used Wave Accounting all the time, because it would pull information directly from our bank accounts, and it would spit out all the financials that we needed. It helped us with our taxes, and it totally disrupted our need to go to a place like H&R Block. So H&R Block looked at Wave Accounting, and it said to itself, okay, here's a disruptive technology and player within our industry who is competing directly against us. Remember horizontal? What should we do about this? This is where the industry is moving. Well, we can create the technology on our own and try to convert our customers to go over to it, or what's the other option? It's either create or buy, exactly. So in this circumstance, because Wave had been scaling so fast and getting such a massive client base and being so disruptive, H&R Block acquired Wave Accounting. I can't remember the exact number, but I think it was maybe around 700 million. And this is a Canadian success story here. So that's a great example of how a venture capitalist can exit the business. The other one is an IPO, also known as an initial public offering. So that's when a private company looks to raise capital by selling the equity or the shares of its business on an open exchange, like the Toronto Stock Exchange, or the New York Stock Exchange, or the NASDAQ. And so they would, that's an exit opportunity for any shareholder because they can also be a part of that, like bringing their equity and liquidating it into one of these public exchanges. So when I talk about something like being an early stage entrepreneur and understanding the mindset of someone you're pitching to, someone you're trying to sell equity to, an investor, I'll wrap it up soon. You have to understand what their motivation is, what are the types of businesses, what's a good fit for that investor. It's no different than you're pitching the public in that regards. But the type of company, the type of opportunity is also very specific when it relates to the public market. So now you're pitching to the general people, general retail investors. So is your company the type of company that could appeal to retail investors? Or is it the type of company that only those who are highly skilled in the technical field and work in the internal operations of a bank would understand? So you have to start thinking long-term for your own business, but especially if you want to pitch to an investor who looks at these things like a venture capitalist. I'm not saying to have a successful business you have to have an exit, but to successfully raise from a venture capitalist, you have to show them that your business has the potential to exit so that you get their money back. Question?
Yeah, just a quick question about the big picture. So I know personally people in this room that have raised $500,000 last month, but when we look at the stats, in 2025, there was a 22% decline in VC and angel investors investment, and 2026 was not that much better. How do you see 2027 for that, from that perspective?
You know what, I honestly, I see that it might continue to go down. And the reason for that is because AI is, you know, say what you will about AI, but it is becoming more and more efficient to start products and scale. And because of that, the barriers for entry for competition is becoming more fierce. So I always, whether you're looking to raise money from a VC or not, I always go back to the fundamentals of business. Like, what you should be doing is focusing on creating a business model where it is appealing to your customer segment and providing real value to them, and you're servicing a niche that is being neglected, and you're focused hyperly on getting your company to the point where it generates positive cash flow from operations. If that's your focus, let your business model evolve the way that it needs to evolve. And if all of a sudden it turns into the type of company that a VC might be interested in, you really need that financing, then pitch the VC.
Thank you.
No problem. Okay, so I'm literally wrapping it up right now. Secondary buyout, this is the final thing I'm gonna mention. All this is another investor that's a private investor, like a private equity fund or a later stage VC, buying your company from the earlier stage investors. So that's the third type of exit that you or another investor might want to consider. Thank you everyone for allowing me to present to you. Feel free to visit our website, pycap.com. You can send us a message there and add me on LinkedIn. Thank you.